Okay, and that is what we call the gamma chart. Now, how do I get this gamma chart? I move down here. If I go into options strike wise gamma, now it should be clearer. I go into what is called a gamma chart, right? Now this is okay, a chart on screen. This would look like your open interest tables, but the entire calculation is very different. So we have open interest tables also, which I'm sure okay all of you are very familiar with, and this is okay how an open interest table okay would look at. Okay, I'm not going to spend a lot of time on open interest because it's a subject okay which everybody knows about and everybody is an expert at it. And today's webinar is not really okay about open interest. It's about understanding okay what else we can find out about the market, right? So this is the gamma chart of all that we looked at in the spectrum. It's a different visualization method of that same picture put up in a different way. So this works like the open interest. So the first thing okay which you do is you go into the plot type and you understand okay where okay the gamma concentration is high. So in this case uh, we've had a very good build up at 21,800, and the gamma exposure was very high at 21,800. It reached up to this level of 1,000, which is very low actually for a Friday, but this okay really shoots up into the higher 40, 50, 60,000 on a Thursday because it's a build up over 7 or 8 days. This is positioning for this expiry, which is the 18th of Jan, and we're looking at it only on the 12th of Jan. Now this is the first day and it is going to keep building. Okay, now this gamma is extremely important to look at on the second last day of the series and the last day of the series, which in the Nifty would be the Wednesday and the Thursday, and it can tell you a bit more about the market and what it possibly can do. Right now, there are two concepts I'd like to talk to you about the gamma visualization, and this is, like I said, it works a little bit better on settlement days and the day before the settlement day. But you have to understand two terms about gamma. And the first term, okay, which I want to talk to you about is something called a pinning effect. Pinning, pinning effect. It's like one stack of column, okay, where the entire market is. Now, what exactly is the pinning effect? So a pinning effect is a market 100% sure that this is the zone in which the closing or the settlement price would be. Okay, and therefore those traders who are 100% sure that that is going to be the strike at which the settlement is going to be, they start building positions around that level. Okay, what really happens is as those positions get built up, other traders notice it and open interest starts increasing, and higher open interest attracts even more higher open interest. Resultant is that at one particular strike, sometimes on a settlement day, you will find okay up to about what I've seen okay about 12 lakh contracts on the Fin Nifty. I've seen about 25 lakhs contracts aggregated on the Nifty. I've seen about 18, 20 lakhs contracts aggregated on the Bank Nifty. Now this is in number of contracts. So when a large number of contracts, and for us okay that number is still 1 million or 10 lakhs, whenever okay that number aggregates at a particular strike, 8 out of 10 times the settlement is going to be at that strike. So this is completely based on something called gamma exposure, and gamma is the reason a lot of open interest gets built up in the market. Right now, a lot of traders, when they build open interest, they look at price. Okay, and if let's say okay we are at about 21,970 right now, that's the futures. The spot okay could be about 21,950. So if price is about 21,950, what will they do? They will write 21,900 PE, and if price is below 21,900, they will start writing 21,900 CE. This is a very primitive way of approaching and trading markets. the actual money, the big money, the institutions, they will write only, okay, when they see gamma as high in a market, right? So let me just come back to this gamma value split. So wherever, okay, you see the market has higher gamma, like in this case, there is a higher gamma here at 21,800. The P gamma value is higher. This becomes a strike to write, not because, okay, price is about 21,800, but because, okay, the gamma value is higher. And you can see over here, this gamma value is higher at 21,700. So this becomes a strike to write. Now you can watch this and better yourself, okay, in open interest. Don't write open interest or don't write positions in the market just because price is at a particular level. Price has got nothing to do, okay, with what can happen next. Price is just an advertising mechanism. Okay, you have to understand structure, you have to understand, okay, option dynamics before you go into deeper writing. So what institutional traders would do, okay, they would focus, okay, on what they are getting in via the gamma, and they would, okay, write, okay, places, okay, of high gamma, such that, okay, it can become more profitable for them. High gamma is equal to higher profits for a lot of institutional traders, right? Also, you can look at this gamma concentration and find out, okay, if this strike, okay, can be broken later, right? So currently, okay, 21,900, we've crossed at the close. This is the spot price, the white line. We've crossed above this 21,900 strike, but this 21,900 gamma is still up over there. So at least, okay, for the next few hours, that is on Monday, of course, these call writers think that they have a chance and this market is not gonna go running higher, right? So just because, okay, price crosses, okay, most of the big traders are not gonna fold positions, and they would, okay, carry position. So most what they have done is they've secured themselves via a 21,900 PE, and they've carried a 21,900 CEPE into the market, right? So this is the way to understand gamma. A couple of things, okay, would happen still. Do your writing based on what gamma does, and you can look at the exposure value. And this is still not, okay, environment, okay, to write straddles, but I've spoken about this extensively on my Twitter feed also. I don't like to see environment, okay, which is not like this, okay, to write straddles. So you want to see a pyramiding structure where you have one strong pillar at the top, almost equally balanced to the left and right, and a third set of equally balanced. So if I see this on a Thursday, okay, I'll know, okay, that the market, okay, wants to pin itself, okay, at one particular strike, which in this case, okay, would be about 21,800, right? So this is, okay, how you use your gamma exposure, and you can make better informed trading decisions